Bonjour à tous. Je suis très heureux de vous présenter donc la deuxième table ronde. Comme on a une audience, je dirais, anglo-saxonne, on va essayer de faire ça un peu plus en anglais. So I'm going to switch in English and check that everyone is still awake. The idea of this second panel is after this educational session is more to have a lively debate with experts on the field of variable annuities. So I'm going to have with me, first of all, Christophe Boucher that you just saw. Then Emmanuel Naim from SocGen, who is the director and responsible for cross-asset solution at SocGen CIB. And Alexis Zagvoglos, head of insurance structuring at Commerce Insurance. So I'm going to start by rephrasing, in fact, what Christophe just mentioned. As he mentioned, the variable annuity business has been still emerging, in a sense, in France. And on the contrary, in the States or in Japan, it has been a very booming business. So I'm going to ask the panelists, why is that? Why is the variable annuity business in France still like way behind? Why is this business as well still like suffering, as it was mentioned in the first round table, somehow not very good reputation in Europe? Who wants to start?
Well, I would say that the main reason why the variable annuity business is still at the early stages in Europe, and it's pretty developed actually in the US and Japan. First reason is actually the retirement system. Obviously, in the US, you have you don't have what we call in French the répartition system, which means that basically the state will actually provide for the individual pensions. So everyone has actually to take care of their own individual pensions. So that's why basically the insurance company actually grow this type of offer. Interestingly enough, you really see that in some areas of Europe, for instance, Germany, the Netherlands, or the UK, for instance, the variable annuity business is actually has already emerged. It's specifically because essentially in those countries you have an individual retirement system. The second point I want to raise is also a matter of culture. The American culture is very much equity-oriented, meaning that it's very natural for individual investors to actually invest into mutual funds. And then came the trick of insurance companies to say, well, you buy already mutual funds, I'm just going to offer guarantees on top of that. So it was a natural evolution for insurers to provide that. Whereas in Europe, the background is way more geared towards bond investment. When you think about what a normal life policy holder in France holds into his accounts, you will find roughly 80% general accounts or with-profit funds and 20% into units. So basically, the variable annuity concept, which is very much an equity plus guarantee type of concept, is a bit off compared to the market model of individual investors. And finally, there's one point that's very important to say is the fact that when we say that there is no variable annuities in France, this is completely wrong, because when you look at the most popular product in life insurance, which is the contrat en euros, the general account, this is essentially a collective variable annuity scheme where you have yearly guarantees on capital, or not even yearly, but actually day-to-day guarantees. You can come in today, and in 3 months you can exit with your capital. You have guarantees in terms of yield, and you have all sorts of actual risks that are embedded into that. So therefore, it's the gigantic variable annuity scheme.
And maybe, Alexis, as you have some experience in Japan, can you comment and say a few words?
Yeah, it's probably worth adding that in Japan, actually, the market has developed possibly, even though the players who arrived there and set up the products were the players that were bringing expertise from the US, actually the success of the product has been driven by different factors. Most fundamentally, the VA product there is viewed as a bank account. If for the last 10 or 20 years, if you put your money in a Japanese bank account, you got 0.5% in interest. That's not very interesting. So what customers were looking for was a guarantee of their capital, which is the same as a bank account, but also the potential for upside, the potential to earn something more than 0.5%. Now, that's actually quite educational to us. We're in a very low rate environment. There is a question of whether this low rate environment in Europe will continue for a long time. And so we have to look both ways when we try to develop variable annuities products in Europe. We look to the US to understand the investment culture and the possibility of having choice and having a lot of knowledge and transparency of what you invest in. But also we have to look the other way and say, what are the alternatives? Over the next few years, it will be very difficult to create short-term guaranteed products in Europe. So what are the alternatives, and is variable annuities, as I believe it is, the answer to many of the questions that the current environment is bringing up?
So if we come back to look to the other way, like the alternative, if we are focusing on terms of product design, according to you, it was mentioned in the first roundtable. What kind of product design for variable annuity would you recommend? It was mentioned that there was target vol. So target vol, I just rephrase what it is, but it's a mechanism to target a certain level of volatility, because it was a burning issue for people doing variable annuities over the last few years, and they lost quite a huge amount on these volatility issues. So what would be your recommendation in terms of product design? What would you say about target vol? Are they still the topical way of designing the fund? What about fund selection? Anything concerning as well fund picking? Can you comment?
I think first thing is, as someone who's been in the variable annuities market for many years now, we as the professionals in this business spend an awful lot of time tearing our hair out worrying about volatility. I don't think most of our customers realize we sold them volatility. So that disconnect is actually very important. Why are we so worried about it and they don't even know they bought it? Target volatility is an attempt to address this question. It's saying, well, if our customer doesn't think they bought it, then maybe we shouldn't sell it. Maybe what we should be doing is actually managing the volatility itself so that neither of us has this problem. We're not manufacturing this artificial problem. The second thing is actually we are very used to presenting a risk profile to our customers. We say, this is a balanced fund, this is 80% equity, 20% bond, and that is a perception of risk. Surely target volatility is just a much better perception of that same risk. So it's a question of education on the customer side, saying we can actually control your risk better and give you the risk profile you want, and then it also gets rid of this artificial manufactured problem on our side. That means that actually, we have huge problems with selling 20-year volatility.
So maybe you want to add something, Christophe?
Je peux peut-être réagir en français.
Okay, go ahead.
Allô? Merci. Je vais peut-être réagir d'abord à la première question sur pourquoi ce retard en Europe et en France en particulier. Peut-être que les variable annuities arrivent une décennie trop tard en France. C'est-à-dire qu'aujourd'hui, en tout cas leur vraie implantation, même si ces produits existent aujourd'hui, mais elles arrivent un peu après cette décennie perdue qui fait craindre cette aversion. On a cette aversion pour la complexité des produits, on a cette aversion pour les produits structurés, et donc on arrive juste après la vague où le pire pouvait arriver à la rigueur pour les variable annuities. Malgré tout, on a vu que ces produits tenaient la route. Et c'est peut-être la leçon, c'est que... Bon, j'ai définitivement un problème avec mon micro. C'est peut-être la leçon, c'est que malgré cette pire décennie quasiment de l'histoire financière, ces produits ont assuré leur garantie. Et effectivement, maintenant, on a un peu peur, à la fois du côté des demandeurs, des épargnants, on a un peu peur de ce type de produit, même si la vague est passée. Et ensuite, pour les offreurs, on a un peu réalisé on n'avait pas anticipé tous les coûts de la couverture. Donc on a eu cette petite contraction de la part des offreurs en se disant, eh bien, effectivement, on avait sous-estimé un certain nombre de risques. Maintenant, si on prend en compte tous les risques, combien ça nous coûte vraiment? Et finalement, comme on peut l'observer pour toute innovation financière, l'offre s'est adaptée et a intégré cette dimension-là. Ensuite, sur effectivement le profil des produits, il faut effectivement, et c'est ce qui est en train de se mettre en place, hein, intégrer ces budgets de risque, c'est ce que je disais précédemment, ces budgets de risque, ces targets de vol dans l'allocation elle-même, ce qui permet d'économiser déjà le coût de la couverture. Et puis, il faut avoir donc ces allocations un peu originales, un peu conditionnelles. On sait que quelquefois, il y a du risque d'alpha, que les gérants vont faire sur une bonne partie de l'année moins bien que leur benchmark. Il y a des configurations de marché très compliquées. Et donc, il faut avoir des produits aujourd'hui flexibles qui permettent de prendre du risque d'alpha, de sous-performance, et de temps en temps de revenir sur des produits peut-être indiciels, d'avoir une gestion flexible de son exposition à l'alpha. Et puis, dans les nouvelles pistes aussi, peut-être envisager, ce qui n'était pas vraiment le cas jusqu'ici, de nouvelles classes d'actifs, d'aller rechercher les produits de diversification là où on ne les attendait pas. Et peut-être qu'une allocation aujourd'hui ne se définit plus seulement sur un couple action-obligation, mais en intégrant des niches de diversification avec des produits absolus, en gérant, via par exemple de la multigestion alternative, en gérant, en visant ce potentiel d'alpha.
This potential alpha, this raised me a question, which is often like variable annuities are compared to their equivalent, like CPPI. So, according to you, what would be the main difference between CPPI and variable annuities? Why would you choose, for instance, a CPPI, as they are often like offered in this kind of business compared to variable annuities? And mainly, like if I am more specific, if you look at the market, you often see that, okay, CPPI, let's say they'll charge something like 50 bips per year, and the equivalent variable annuity will be charged 150 bips, so something like 3 times. How would you reconcile, in a sense, why would you rather like go for variable annuities as they bear, in a sense, a heavy cost compared to CPPI?
Well, from the outside, it seems like there is an arbitrage opportunity, right? Why actually would you want to pay 150 basis points for an optional guarantee when you can actually buy a guarantee in principle and CPPI for just 50 basis points? Well, there's no arbitrage opportunity, unfortunately. The answer is that essentially when you buy CPPI, you have a huge monetization risk. Now, when equity performs well, I mean, you might very well end up having something that looks like purely equity. However, when you're looking at retirement investment and you're looking at very long-term investment, looking at 10 or 15 years, you see that essentially the probability of having a boom and burst cycle is quite high. I would say we just seen one, meaning that the probability of having basically monetization on your CPPI type of methodology is quite high as well. Which means that all the insurers and all the asset managers actually who have been proposing this type of structures in the last 2 or 3 years are now dealing with some sort of monetary funds. So the main difference between I would say variable annuities in the option understanding of it and CPPI is essentially the lack of monetization risk that you have into an optional type of guarantees. So definitely, when we're talking about retirement investment, we definitely favor option-based type of guarantees. Yeah.
Okay. Maybe Alexei, you want to add something?
Sure. I think with a CPPI, you need to be able to explain 2 things to your customer. Number one is why he's essentially in a money market product if the market falls a lot. But actually, number 2 is why, when the market went down and then up went down 10% and up 10%, why is he not back where he started? If you can explain that to your customer, then you can sell him a CPPI. So to my point of view, the CPPI is to be sold to someone relatively sophisticated. We shouldn't be trying to seek a one-size-fits-all product here. In variable annuities, it's a mass market product which is extremely transparent and extremely simple to explain. The customer pays a price for protection, he gets that protection, and otherwise he gets participation in the market. So that, for me, is a mass market product. In terms of providing a CPPI, you can provide a CPPI to a high net worth individual to whom you can explain this complexity of the asymmetry of a CPPI, because you can bring the advantages of actually being able to give him a broader range of funds, being able to give him alpha, being able to give him funds that are not so easy to model. So there are two different markets. My belief is that CPPI is not a mass market product, and it's in fact a very dangerous product to sell to a retail market.
Alors pour compléter peut-être un tout petit peu, d'abord la première grande différence entre les CPPI, déjà qui sont des méthodes très très différentes, très très variées dans les CPPI, et les variables annuities, c'est d'abord le risque de longévité qui n'est pas intégré. C'est déjà la grande différence. Ensuite, plutôt que deux approches alternatives, ce sont deux approches complémentaires, puisque on le voit même dans la nouvelle génération de produits, l'allocation d'actifs intègre déjà des gestions type CPPI ou grande famille de CPPI avec budget de risque. Donc une gestion avec budget de risque ou budget de vol ou CPPI, c'est très proche. On peut redéfinir le produit comme une reformulation de l'autre. Donc malgré tout, ce sont deux produits complémentaires. Et effectivement, il y a un risque de monétarisation, mais l'idée, c'est plutôt d'intégrer justement le CPPI à l'intérieur de l'asset allocation.
Oh, okay. Just maybe to comment, yes, true, vol target mechanism and CPPIs tend to follow the same methodology. However, there's a big discrepancy between the two is the fact that in a vol target mechanism, you don't ever have a risk of monetization when a CPPI has a big one. And that's actually one of the reasons why investment banks and now insurance companies are actually promoting those type of underlyings. It's because first, you don't have that monetization risk, and second, when pricing options linked to vol control mechanism, you're actually dealing with a well-mastered price of guarantees. Whereas when you have to price very long-term options on underlyings with no vol target mechanism, you can have like huge variations of price just because the price of the market on that particular volatility is actually jumping all over the place.
So coming back to product design, I think, okay, we've seen that there is a real added value in variable annuities because they don't suffer from monetization, and they are, in a sense, providing other guarantees, and they can be very complementary to CPPI and include somehow like CPI mechanism. What about basis risk? That's something like which is often said in the press, like in fact, you suffer from basis risk. What would be your idea in terms of product design? And I'm going to commence this time by Christophe.
Je préfère passer mon tour. Je ne suis peut-être pas le plus spécialisé pour parler de design des produits, si ce n'est sur l'asset allocation, donc je préfère laisser les deux autres intervenants réagir. Okay.
Well, what do we mean by basis risk? Essentially, when you write variable annuities type of product, you're essentially writing put options. Any type of guarantee is actually writing a put options. So when you're a dealer and you want to issue put options, you have to actually be short on the underlying, which means that you need to borrow the shares and to be short on that particular underlying. So now that is very easy if you're dealing with broadband indices like the Eurostoxx, the CAC 40, whatever. However, it might be a bit difficult if you're doing this onto a mutual funds on which it's very difficult for you to borrow the shares. So essentially, one way of dealing with that is actually, instead of having on one side the funds and on the other side the guarantee, is actually to have the same company, the same provider, providing both the assets, so therefore the funds, and the guarantees. The advantage of this is that by providing the assets, you already long the shares, which you can easily short because you just reduce your exposure. So that's one of the reasons why a lot of US insurers made so big losses actually during the crisis, is because they actually teamed up with asset managers and were independently writing guarantees on top of those funds without having the ability to short the units by themselves. So that's why when the crisis erupted, the huge basis risk, the discrepancy between the proxy of the insurance companies and the funds actually made them lose a lot of money on their hedging strategies.
So that's very interesting. I see that you are all real expert. So around the table, I see that we have here 3 bankers. We had previously insurance companies. So I'm wondering how everything fits in. So like, what is the key strategy? Because like we see that banks are converging towards like offering more and more products in variable annuity business. You have the same strategy in the insurance companies. So according to you, what are the key strategies of both, and how do they collaborate in a sense? And I want something quite polemical so that there are some reaction in the room, and do not hesitate if you have any remarks so that we have a lively debate.
I'm not going to be too polemical. I'm a guest here, but you know, as a bank, we do have a strong view that capital market risk is best dealt with by banks. There are many reasons for this. I think when you break the product down in terms of the actual risk, it is probably something like 80 to 90% capital market risk and 10 to 20% actuarial risk. So in terms of where the balance of the risk is, I think it is capital market risk. Now the next step is to say, okay, who should manage that capital market risk? And our belief is that actually insurance risk and capital market risk are structurally extremely different risks. You can look at it in one sense, what do you need? What do you need in your office in order to be able to manage capital market risk? That's one thing. But the second question is, what do you need culturally? How does your organizational culture need to look in order to manage capital market risk? An example of that is, an example and a counterexample. In September 2008, we were looking at the markets and wondering what was going to happen. We were watching Lehman and we were wondering how to react. Now, as a bank, our trading heads got together extremely quickly, looked at the market and took a decision to put on a position ahead of the market to protect us. So we aggressively went and actually bought put options on the S&P market. That was a very senior management level decision to put that on the books to protect us. Now, we had two things in our favor in order to be able to do that. Number one was the kind of systems that could give us our risks on a real-time basis, so we knew exactly what our positions were. And number two, a management culture that understood capital market risk and could react quickly. And here I'm talking about within an hour, I'm not talking about within a day. So these two things I think are endemic in all banking cultures and infrastructures and not in the insurance companies that I know, certainly. The other thing is, the counterexample is our entry into life settlements business. For the insurers here, you've probably watched on the sidelines as banks have lost a lot of money in life settlements. The reason is exactly the converse. We're not set up properly to assess actuarial risks. The last point I wanted to make is the banks are actually set up to trade all sides of a business. If you, as an insurance company, set yourself up to sell variable annuities, what you're going to do for the next decade or more, hopefully, is sell put options. And all you're going to have is a book full of short put option positions. That is a very, very dangerous place to be. You're exposed in terms of not only the capital market risks that you'll hear about, but also the model risks. Is the model you're using correct, and what happens if it's wrong? As a bank, we have positions coming in from all different sides. And so if our model is wrong, we're actually much less exposed to it being wrong than an insurance company would be. And this applies to many other variables. So I'll stop there. I could go on for about the next hour. But our belief is certainly that capital market risk should sit in investment banks, insurance risks should sit in insurance companies, and the operational risk of managing a capital market position can only really be managed by a proper trading culture.
So here I hear you are talking about separating, in a sense, the role, like the role from the market goes to banking, the role from everything concerning actual and behavior risk to the life insurance company. I heard as well that you were talking about system models. So to your experience, what would you recommend if someone was starting a VA business? What kind of tools, like system, pricing model, would you recommend? What are the current, like, as well, market standard for pricing models?
Well, I think the answer is quite dependent upon the product design that you select. I think most of the risk management that is involved into variable annuities actually start with the product design. If you have the right product design, you will end up using actually a very simple model, and you don't need that multi-stochastic type of model to hedge your books. Supposing that you have actually a very simple and controlled type of product, I would say that the only requirement that you have is actually to have a very simple pricer that you would use, I would say, basic Black-Scholes and maybe some more ramifications around that. But in any case, it's just going to be basic as long as you have something that is rightly designed from the start.
So it can be basic, but what about like I'm going to be a little bit more polemical. It was mentioned that you need some dynamic hedging, you need some delta hedging, some vega hedging. What about that? What would happen if you ignore that in a sense?
Well, I mean, there's several ways of handling this dynamic hedging. Either you go, as Alexis was mentioning, see a specialist for market risk, so a bank, and try to strip out essentially the actual risk and hedge perfectly your market risk exposure with a bank, and therefore you actually don't need to run all those dynamic hedging type of approach. If you don't and want to actually hedge yourself, there was a very interesting graph actually that was showed in the prior panel by our colleagues from Barclays, showing basically the danger of running only a delta hedge versus running a delta plus gamma hedge versus running three variables, so delta, gamma, and vega hedge. So all of this actually boils down to the fact that the more precise you are, the better hedge you're going to get out the right sensitivities. So for all the Greeks, and I think that's basically using tools that are waterproofed, and for instance, we do rely a lot on pricing partners type of softwares. Is definitely something that can be used.